Good evening, everybody, and welcome back to another Sampon class. Stan, can you hear me? Am I audible? Okay, am I audible enough, or do I need to speak up?
Maybe you should speak up for people who is recording.
Okay. So, good evening, everybody. Is this better?
Clear.
Yes, I can hear you.
All right. So, where do I start from? First of all, I think one thing I don't want to forget to talk about is the assignments on the group. I dropped a voice note on the announcement group and at the same time on the questions group as well. Most of the questions that have been coming in regarding demand and supply, they have been very smart, right? When you're teaching, there may be things that you forget to lay emphasis about, and then questions poke these things. Do you understand? They've been very, very smart. So it's important that for most of you, right, that have all the time, even if you don't have all the time, try to create some time, 30 minutes in a day, just go through the question group. Look at what people are asking and listen to the replies there. I'm telling you, like, definitely, the reason why I'm saying it is because it is as important as I'm emphasizing on. Go through the question group once in a while, and you definitely learn something. And even if it's not something new, you're going to emphasize on something that you already know or something that you thought you understood before, right? Something like that. So today I'm going to be reviewing demand and supply again, because I know that as much as some people are getting it, some people are also confused, right? So there's no rush. Remember that I told you guys in the beginning of the demand and supply, I told you that you should picture a case scenario whereby somebody comes to you and gives you a packet of pen as in biro, right? Someone comes to you and gives you a packet of biro. Now, if that person gives you a packet of biro and the current price of one pen is 20 naira, right? As someone that is looking for money, you would agree with me that you would want to wait until that pen is what? Until that pen is like 100 naira before you sell, right? Now, this is in the perspective that what you are the one that is what? That is you're the one that have the pen, right? You would want to wait until the pen gets to what? 100 naira before you sell. Perspective of what? Seller. Meaning that what you're looking to sell at a higher price. You're looking to sell at what? 100 naira. Now, let's imagine another case scenario that you are the one your mom sent to the market to go and buy a packet of pen. Now, when you get to the market, they tell you that one pen is what? At the price of 100 naira per pen. You would believe me that most of you, okay, let me just say 500 naira per pen, right? You'll be like, now 500 naira is too much. Madam, want to sell for what? Want to sell for 300 naira. This is the perspective of what? A buyer. In this case now, you're what? You're buying. You're pricing the price. You're pricing it down. But when you're selling, you're trying to what? Increase the price. That's the same thing that happens in this market. You're as a good trader, you're looking towards buy at lower prices and you're looking towards sell at higher prices. You want to sell at a very high price, from a very high price to make more profits, or you want to buy at lower prices to what? To save more money. That is how buyers and sellers also interact in the market. And I told you guys that there are two types of demand and supply zones. Any other demand and supply zone that you see anywhere, at any point, at any time, we are all engraved from what? From these two. In fact, I think whenever you look for types of demand and supply zones, these are even the ones you see. But if you see any other thing, you find out that they are still related, or would I say, taken out from these two. And which are what? The pivots, demand and supply, the pivots, and the range created what? Range created demand and supply zones. So we have pivot demand and supply, range created demand and supply zones, which if you guys remember the class we had on market structure, I told you that there were three types of market structure, which is what? The uptrend, that's the one that I drew that looks like it was going up like this. The downtrend, the one that I drew that looked like it was going down like this. And then the one that I told you, if you remember the example I illustrated when I said that people of equal heights or similar heights jumping to the roof and back to the tiles, which is what? The equal heights. I told you that these three types of trend, they have what? Something in common, which is that all of them have what? Both highs and lows. Higher highs, higher lows. Lower highs, lower lows. Equal highs, equal lows. They all have highs and lows, just that it's different types of what? Highs and lows. But now my concern is that third type of market structure, which is moving like this, right? Equal highs and equal lows. Equal highs and equal lows. Remember, higher highs and higher lows, uptrend. Lower highs and lower lows, downtrend. Equal highs and equal lows, the ranging or consolidation market structure. Now, equal highs and equal lows. If it rings a bell to you, equal highs and equal lows, when we treated liquidity and inducement, when I introduced this, what did I say? I said that there is liquidity resting above all equal highs and below all equal lows. I want you guys to put all of these things together. That is why they are taught separately, so that combining it will be easier. This is market structure. But then this type of market structure is a form of liquidity. This ranging market structure, because it is made up of what? Equal highs and equal lows. I told you that at every equal high and equal low in the market, there is what? Liquidity resting above or below, depending. So which means that if price creates this ranging market structure that has what? Equal highs, right? It can decide to sweep the liquidity, either resting above or decide to sweep the one resting below. If it decides to sweep the one resting above, what will it look like? It will look just like this. Let me squeeze that a bit. If it decides to sweep the one resting what? If it decides to sweep the one resting above, this is what it will look like. Just like this, right? Price taking out the equal highs to create something like this. Now, the process of price sweeping this particular liquidity resting on the highs of this range market structure, right? It creates a demand, which is the demand zone that we call the range created demand zone. I told you there are two types of demand zone earlier, right? Demand zones, range created demand zones. So which means that if price breaks out of a range to the upside, that is actually what this range created demand zone means. It just means, just like the name, what? A demand zone that is created from a range. Price breaks out from a range to the upside, that is what? A range created demand zone. And if price decides to sweep the liquidity resting below first, what does it do? This is what it looks like. It breaks what? It breaks to the downside, taking out the liquidity resting on the lows. This is what? This is a range created supply zone. It now creates what? A supply level, right? Creating a range created supply zone. So this is the first type of demand and supply, called the range created demand and supply zones. They are what? They are just created from ranges, just like the name implies, right? They are created from what? Ranges. Usually, supply and demand zones are formed when price pushes rapidly from where orders are placed. Price just like has an impulsive run. It creates what? It creates supply zones. Or impulsive run. It creates what? It creates demand zones. Just like that. So when price breaks out of these ranges like this impulsively, it creates demand or supply zones. And that is what the first type of demand and supply. Now, the second is the pivot demand and supply. This is what the pivot looks like. It just looks like a V like this, or an A like this. Demand, supply, just like this. And these ones are usually found in the trend and downtrend, right? You usually find these ones as prices are creating higher highs and higher lows, just like this. That's how you find price creating what this type of pivot demand and supply. That is why I told you guys. Remember that I told you people that every higher low in an uptrend is what a demand zone, but demand zones are not limited to higher lows, which means you can find demand zones on the chart at different places on the chart that are not just higher lows in an uptrend. I know that at least everybody in this class understands English to a good extent, right? So you should understand what I mean when I say that every higher low in an uptrend are what are demand zones. But demand zones are not limited to just higher lows on an uptrend. In an uptrend, there are demand zones all over the chart, but you are sure that every higher low in an uptrend is a demand zone, but you can find demand zone where in other places as well. Every lower high in a downtrend is a supply zone. Every lower high in a downtrend is what a supply zone, but they are not limited there. It means that you can find supply zones in other places that are not what lower highs, but you are sure that every lower high is what a supply zone. But then that does not validate these demand and supply zones. No, the fact that I say that every how do I put this now? Okay, we have two genders, boys and girls. I'm trying to use something unique to boys that wouldn't be so out of place. Okay, let me say, hey, everybody that braids their hair is a girl, right? Let's say that this is something very unique to just girls. But that does not mean that you cannot find people that braid their hair in the other gender as well. I don't know if you get what I mean. So which means that you can find demand zones at higher lows, but you can also find them in other places what on the chart. And not every demand zone that you see on the chart is valid to buy or to sell from. Of course, it's a demand zone, but not all demand zones are valid to put your money on. Of course, this is a boy, but the father is a boy does not assure you that it's what a good boy. The father is that this is what a demand zone does not assure you that what this is a good demand zone. Do you understand? So this is to say that there are what valid demand zones and invalid demand zones. There are what good men and bad men. There are what good women and bad women. Just like that. They are all women, but they are good and bad people. They are all demand zones, they are all supply zones, but they are what good and bad supply zones. And that is where you must apply what our validations, our 6 validations for what validates a demand and supply zone. At least you understand that when you can recognize a range and price breaks out of that range, you can recognize what a supply or a demand zone created by that range. Or at least most of you now can understand that if you are able to mark out market structure, then you know that what every low. Sorry, Stan, can you hear me now?
Yeah. We lost you for a while.
Yeah. Sorry, this is the light, so it interrupted my network.
Okay.
But you can hear me clearly now, yeah?
Yeah.
And the recording is still perfect. All right. So back to what I was saying, I don't even know where you guys stopped hearing me. But let me just start afresh from the last thing I can remember saying. As I was saying, if you're able to recognize that if price breaks out to the upside in a range, Stan, please, if I should get disconnected again, send me a message on WhatsApp.
Okay.
So as I was saying, if you are able to recognize that every higher low in an uptrend is a demand zone, right? What happens? You mark out this your market structure properly, and then you start validating these higher lows. Those are like the most common places that you see demand zones, trust me, right? Demand zones can be formed like as prices, that price movement between a higher low and a higher high. Multiple demand zones can be created as well. That is why I told you that it is not limited to just higher lows, right? But higher lows are the short places that you would find demand zones. Lower highs are the short places that you find what supply zones. So you can just start with the ones that you can recognize. And then with time, you're able to what put these things together. All right. So I don't want it overwhelming most of you. I notice that some people are attempting assignments, other people are not attempting assignments. Or if you can identify a range, after all, most of you did supply and support and resistance assignments, right? You're able to identify both support and resistance in the same place, something just like this. You're able to identify what both support and resistance like this. Most of your assignment was support and resistance. This is what they looked like. This is a range. Price breaks out to the downside, creates what? A range created supply. Breaks out to the upside, creates what? A range created demand. Then you look out for things like this and you validate them. If they can meet your 6 criteria, then they are valid demand and supplies. That is what you mark out. You check, you go to the chart, you check what has price currently what reacted to. And then you try to validate why the price react to the zone. This is how you learn, by attempting, not constantly, this is the slide again, not constantly shouting that attempt. Now, this is especially for the person that I told that I was going to explain mitigated and unmitigated zones on the chart, right? We have, these are all, Stan, can you hear me?
Yeah.
Okay, sorry. My trading view just refreshed, so I want to make sure that I'm still with you guys. So these are all demand zones here. We have 1, 2, 3, 4, and 5 demand zones. Let me add this one now to the 6. We have 6 demand zones here on the chart. Now, if you look at this, the first 3 are different from from the last 3. If you look at what is happening here, the first 3 are different from the last 3. Now, I told you, I was trying to explain. I said that in mitigation, I just want you to look at mitigation as touch or tap. If 6 people are standing in a row, right? 6 people are standing in a row, meaning they're standing in a line. You know that thing that they call hands on your neighbor's shoulder in primary school, I think, right? Now, imagine that some people are placing their hands on their neighbor's shoulder, while some people are not. The ones that have touched somebody, or the ones that have been touched, are the ones that we call mitigated. The ones that are yet to be touched are the ones that we call unmitigated. So in this case now, you can see that this particular demand zone 1 has been mitigated, because demand zone 2 has Demand zone 2 has come to pick up the orders resting on it. The moment price comes, touches a zone, and starts rejecting from that zone, that is a mitigation. Price has picked up the buy orders. The buy orders resting on this zone has been picked, meaning that price has mitigated this zone. When price touches a zone and reacts from it or fails it, that is a mitigation. If you understand this explanation, then you understand that this is this demand zone 1 has been mitigated. Demand zone 2 has been mitigated. Demand zone 3 has been mitigated. But if you look at demand zone 4, price is yet to come to it, to touch it. So demand zone 4 is unmitigated. Demand zone 5 unmitigated. Demand zone 6 is unmitigated. But if price decides to do something like this, to come to it like this, this is a mitigated zone. So when you mark out a demand zone and price is yet to approach that demand zone, or price is yet to touch, tap, mitigate, whatever, price has not gotten to that zone, price never reached that zone, that is mitigated. That is an unmitigated demand zone or supply zone. But the one that has been touched, tapped, gotten to, failed, invalidated, or whatever, that is what? That is a mitigated zone. So every demand zone that you're mapping out to buy from must be what? Unmitigated. You cannot buy from a zone that price has already reacted from. Do you understand? So you cannot buy from previous demand zones that price has reacted from. When you are trying to look for demand or supply zones to buy from, they must be the ones that price is what yet to approach, or price is what yet to, price is yet to tap or mitigate. Those are the ones that you're looking to buy or to sell from. And then I think somebody else mentioned how to map out demand and supply zones that I said I was going to show you in today's class. I didn't want to emphasize proper. Most likely, I told you guys in the beginning of this class, when we were talking on candlesticks, I told you that the most important candlestick when it comes to trading, as far as trading is concerned, the most important candlestick is what? The engulfings. And if you remember, I told you that the most powerful is what? The dodgy candlestick. Now, I want you guys to note this. When you're mapping out demand zones, most of the demand zones, most likely, right? Majority of times, the demand zones that you're going to be mapping out with, they are going to be created by engulfings. Most of the demand zones that you're validating, this is what they look like. They are created by what? By engulfings, just like this. You see what is happening here, right? This is how it usually looks like. So when you're mapping it out, for those of you that don't know what to map out on the smaller candle, right? In the case of a supply zone, a demand zone just like this, I'm not validating this here, I'm just giving an example. In the case of a demand zone just like this, you map out from the tip of the smaller candle to the bottom, just like this. And then you extend, right? You can see the smaller candle in consideration. This is especially for the newbies. For those of you that know how to refine yet, just forget about what I'm doing, right? And then if you're mapping out a supply zone, most likely your supply zones are going to be mitigated by what? By something like this, a bearish engulfing candlestick. So when you're mapping it out, you're mapping out it what? With the tip of what? The bullish candle to the other end of what? The bullish candle. Remember here, you're using what? The tip of the bearish candle to the other end of what? The bearish candle. So here you're using the tip of the bullish to the other end of what? The bullish. So long as it's an engulfing candle that created what? That demand zone. This is something that can work out. So this will show you the extent to which your demand or supply zones should be like. For those of you start asking how we decide etc, etc, this should be what you should do. This is what you can be doing for now, right? And I think one other very popular question is what? Sweep. What exactly is a sweep? Now you remember that sweeps were part of what? Sweeps were part of our criteria and validation for a demand and a supply zone. Now, one thing I want you to know is that when price takes out a low or a high, it has swept that low or high. So when you see price do something like this, take out this low. This is what? This is a sweep. Something just like this now is what? A sweep. So when you see price take out lows in an uptrend, it has swept that low. This is what that sweep looks like. Or when price takes out highs in a downtrend, just like this, it has what? It has swept that high. Something like this now. It has swept what? It has swept that high, just like this. Now the reason you can see, wait, let me extend this properly, sorry. Okay, something just like this now. When price takes out what? This lower high in the downtrend, it has what? Swept that high. Taking out of a zone is sweeping that zone. You have swept the liquidity resting above it, right? or you sell the liquidity resting below it, right? So this price taking out external lows and highs, even internally, price still sweeps liquidity what internally. Let me show you guys an example. There was a trade I took on I think ERNZD. Let me show you. I think it should still be safe. If it is, let's see. Okay, yeah. If you look at what happened here now, this was a zone that I took a buy from. Now I want you to monitor this particular validations. This is a demand zone that I bought from. The first thing that I told you about demand zones is number one, they must be in line with the trend. If we should map out this market structure together, price was bullish. If you look at what was happening here, price was bullish, creating a series of lower highs and higher highs and higher lows, higher highs and higher lows. And then secondly, I told you the break of structure. The demand zone that created this it actually broke structure internally. This was like a confirmation to the mitigation on this demand, right? It broke structure. And then the next thing that I talked about after BOS is the premium and discounts. Now, if you should map out 50% from this low to this high, here, this is, thank God I said this. This has just reminded me of something else. Now, when you're mapping out your 50% in something like this, you're trying to map out 50% to know whether price is in premium or discounts when you're trying to validate your demand or supply zones. Your 50% is going to be 50% of the higher low and higher high in consideration, or lower low and lower high in consideration, just like this. This one is right. But this one is wrong. You're not including the inducement leg, right? Because if you should do something like this, you notice that when you do something like this, 80% of your invalid inducements are now going to push into the 50% leg. Do you understand? So when you're trying to determine whether a demand zone is in premium or discount, this is the leg you're using, the leg that contains that demand zone. Don't extend it to the highest break of structure or whatever. It must be, this is right to do, this is wrong to do, right? So which means that if I'm trying to validate this now, this is right to do, but this is wrong to do. To take it here is wrong, but to take it here is okay to do, just like this, right? And if you look, you met our premium and discounts. The fourth one, the inducement, yes, there is a form of inducement there, which most of you should be able to recognize at this point. At least if you cannot recognize every other inducement, structural inducement should be one that you can see very clearly now, right? So there's a form of inducement there, which is the structural type of inducement, right? And then the fifth one, which is, first of all, the inducement I told you guys, your inducement at any point must pull back into 50%. Now you can see this inducement. Now you can see that it entered this 50%. When you're buying, your inducement leg must be inside your discount. When you're selling, your inducement leg must be inside your premium. These are things that you shouldn't just take lightly, right? Because one or two wins may make you distracted and you start assuming these things are normal until you start incurring multiple losses. Your inducement leg must be in premium when you're selling and must be in discount when you're buying. This is to say that if this structural inducement, the structural liquidity was like this, let's say price pulls back like this and then puts in a new break of structure, it's not a valid demand zone to validate. It's not a valid inducement to validate this demand zone, which means that this is not valid to buy from. Why? The inducement leg did not pull back into 50%. So these are things that you must pay attention to. Your inducement will pull back into 50%. Now the next one is a sweep or or what do they call this again? Order flow, right? Sweep or what? Or order flow. Now, if you look at this, I told you that when price takes out a low, what is it? It is what? A sweep. And you can see in this case that the first mitigation on this demand zone created a low that this new one that later book structure internally swept. The sweeping of this low, the significant sweeping of this low creates what? Creates a sweep. You can see that this is clearly not equal lows. There's difference between what equal lows and a sweep. This is not an equal low. This is what? This is a sweep. When price takes out what lows and highs on the chart, right? Price clearly swept this level. So you can see that this particular demand zone did what? It had a sweep. And what respect to order flow, it was a mitigation, more like what you guys call confirmation on this demand zone. Right? Price was clearly reacting from what this demand zone. You can see that this met every criteria of what a demand zone should be like. Tell me why you won't execute. Right? So these are how you validate these demand zones. Clearly, they must meet every one of them before you put money on it. Trust me, you can see on my watch list, I have every pair, every Forex currency pair is on my watch list. Every one of them, I think, for this particular trading view chart that is for this class. Even on my other trading view, every Forex currency watch list is there. There are some of you that definitely I know are going to be limited to some pairs, right? When you practice what works for you, there are some pairs that you consistently trade, which is fine. But if you have 5 pairs on your watch list and you come the first day, you analyze all of them and you don't find what a valid demand zone to trade from, that is fine. It is not like you don't know what you're saying. You're not saying what you want, which is what very okay. You cannot go 5 days, 5 trading days in the week that you don't see one trading opportunity in every 5 pairs. It's really not possible. The worst that can happen is that you missed the trading opportunity, but there's something that must print. So you have every opportunity to be patient enough for these validations, right? One thing that works traders the most is the patience to just wait or to not assume. There are times whereby most of you that are already trading, you can have price create something like that, and then the inducement does not pull back, and you're like, it doesn't matter, but let me just put money because if this thing plays out to pay me, if this thing does not take me to pay me, and you end up losing money on things like this. Most of the times, losses are avoidable to a very good extent. Some losses are avoidable. It's not all losses that you take that you should blame on the market. Some of them are what's actually avoidable. Cram your validations if possible. You see my students at like a star. For many of them, go and ask them. For the ones that you know, I know that some of them have their brothers and sisters here. Ebuka's, I think that is here. Brothers and sisters are here as well, right? Go and ask them. Most of them had these validations on their chart, watermarked on their chart, that when they open their trading view, that's what they're seeing first. It's very important that you know them offhand, right? You know them offhand. You can easily, when you're mapping out demand and supply zones, there's no one that you're missing. If you have a journal, you can write them down. They are important. They are very important. And the more that you use them, the more you get used to them, right? And the lesser losses you incur, right? So I want you guys to make sure that you pay very good attention to these things. I think is there something else I'm missing among the things I said I was going to take today? I don't know if there's something else I'm missing. Let me see. Okay. So far, I think I should have covered most of the things that I said I wanted to emphasize on again. So I want you guys again to go back to the charts for those of you that were not able to attempt the assignment the last time. I want you to go back again to the chart. There are so many currency pairs all over. There's AUD USD, there's XAU USD, like a lot of them. You can pick any pair of your choice. Just try to validate 2 or 3 demand zones or validate 3 or 4 demand zones. It's not even like predicting live action or analyzing live price action. This thing I'm talking about is what has happened before. Previous price action. Look at zones that price has reacted from before and try to what? And try to validate it. Why did price react from this? Look for 2 or 3 that met those 6 criteria that you can recognize that met what your 6 criteria. Just looking at this chart now, I can see something on this AUD USD. There are so many of them on the chart, right? For I think you guys just leave AUD USD out of it because most of you will be seeing mainly reclaimed blocks. Look at other pairs as well, right? There are a lot of them. JPY pairs that have JPY, NZD as their code currencies. You would see a lot of good demand and supply zones there, right? Look at these things. Try to validate them. Try to learn as well. It's not just theoretically whereby I'm saying. Okay, somebody said I didn't talk about imbalances. So imbalance that I meant or that I was talking about in the previous class. Imbalances are just inefficiencies. For you to say that something is what imbalance is okay, is synonymous to what? To unfair. When something is what? Not balanced, it means that thing is not fair. The market is supposed to be a place that has equal opportunities for both buyers and sellers. So imagine now when only buyers are just what? Having their way in the market without sellers being able to what? To do anything. Buyers are just buying, no sellers what? Interrupting. That is going to create a disruption, or that is going to interfere with the balance in the market, thereby creating what? An imbalance or an unbalanced market. Creating an unbalanced market, an imbalanced market, right? Or an unfair market when these inefficiencies are created. Now, when the market notices that, okay, I think I'm being partial, only buyers are having their way in the market, it's going to what? It's going to now try to, will I say, compensate those sellers that were not able to do anything in the market. That way, the sellers are now going to want to come back to what? To feel for the damage that the buyers have done. That is why you see that most of the times the price creates these imbalances that have like a run to the upside or to the downside. It always comes back what? To either create another run to what? To the opposite side, to at least 50%. So because you know that for every time the price thinks, oh, I'm being partial, I'm being unfair, it always comes back to try to make it up. It means that these places are what? Price magnets. Because when price notices that this place is what? Is being partial, it's going to want to come back to rebalance it. It means that those zones, they attract price. So these imbalances are what? They are price magnets. If you look at that EUR-NZD that I took, let me see. If you look at the EUR-NZD, okay, this was it. This was what? This was the imbalance. You can see what happened before my entry. This is one of our criteria. The imbalances was one of our criteria for validating what? A demand zone. You can see before this entry now, you can see what? An imbalance resting just before it. Price was what? Price was having a run, created the first demand zone, created the first bullish candlestick, second bullish candlestick, third bullish candlestick, fourth bullish candlestick. That is what? That is unfair because it's supposed to be bullish, bearish, like price is supposed to what? Give sellers equal opportunity in the market. And you can see that since price is what? Since price has created this imbalance, it gives you what? An assurance that price is going to come back to what? Fill this imbalance. The assurance that the price will definitely come back to fill this imbalance is what that price magnet that I'm talking about. So you need to have this type of imbalance before your entry so that as price is coming to fill that imbalance or compensate the sellers for allowing buyers to buy for a long while, as it's coming towards fill the imbalance, what will it do? It will mitigate your entry alongside. That is why it is important to have what imbalances before your entries, so that as price is coming to fill those imbalances, you just mitigate your entries from there and what continue, right? That is the importance of imbalance in relation to what our validations. And then somebody else said something. The person said, okay, I should talk about the retracement that I said. Okay, let me say something. Now, minus validating your demand and your supply zones, right? There's something very important as well that I think I didn't lay enough emphasis on, right? Minus validating your demand and supply zones. I'm coming, please. One thing that you should always check is where price is reacting from. I think I don't know if I'm talking too much on what I should be saying at entries on these demand and supply zones, but it is very, very important that when you're mapping out the demand zone, you should check what where price is coming from. But when you're mapping out the supply zone, you should check what where price is coming from. If price is coming from a demand zone, just like this, let's say price is what mitigating a demand zone just like this, you may be looking to take a supply zone that may have like an internal liquidity, internal inducement, all of that, internal break, this and that, right? Meanwhile, price is what currently buying from a demand zone just like this. This is going to take out this point. And that is why I keep on emphasizing on staying with the trend, right? You would really, really save yourself a lot of losses when you decide to leave counter trading. Definitely, you would save yourself a lot of losses when you decide to. I know that most of the times you catch more trades when you're counter trading because you make money as the market is expanding, you make money as the market is retracing. But some of the times you end up losing money as well. And how consistent and how strong can you be to bear those losses and not allow it mess you up psychologically? So please, when you're validating your demand and supply zones, pay attention to the trend. It is very important. Look out for only demand zones in uptrends. The moment price changes character, change with it. Let your physical character change too, right? Look out for only supply zones in downtrends. Forget about trading against the trend, catching those quick ones. Most of the times, you'll probably be in profit for a while and then price retraces against you. That happens a lot of times. You can have price do like 2 weeks to reward, 2 RR in a 5 RR trade, and the next thing you see what you're seeing stop loss. These things can destabilize you. They can like fuck you up psychologically, right? These are things that you should just totally avoid. Okay, and then somebody talked about those supply zones need to be unmitigated. Yes, I said any example I give you on demand, I want you to as well I want you to as well play it out with supply as well, right? Any example I give you demand, relate it to supply as well. Demand zones need to be unmitigated for you to buy from them. Supply zones need to be unmitigated for you to sell from them. A zone that has been mitigated, it only means that the orders on that zone has been picked. It is now useless. Any zone that the orders has already been picked and has been filled, it is now what? It is now useless. So you're buying and selling from what? Unmitigated zones. I already showed you guys examples of these unmitigated zones, right? Somebody said I should show more examples of mapping out this demand and supply candle wise. Okay, look at this particular one that I took now. Something like this. This is how you can map it out, right? From the smallest candle on the upside towards from the smallest candle on the upside toward the lowest candle downside, just like this. If there was a demand zone resting on this point now, how would I map it out? I would map it out from here to this point, just like this, right? The small one up to the lowest candle down, just like this. If there was a supply zone, let me use a supply example now. Let's say, if there was a supply zone like this now, how would I map it out? Just like this. So I want you guys to be using the engulfings, most especially, right? I want you guys to be using the engulfings to map out your supply and demand zones. Once you get to entry, then I'll teach you guys how to refine. I talked about, for the person, I think Prince, that just asked this question. I think you joined the class late. I literally explained that particular trade. So this is already like 9:54. So the class is not so long for people that would love to go over recording. If you have any question, drop it on the question group. I'll try my best to reply.